Beyond Meat last summer, the enthusiasm that pushes that initial pop usually continues once it's public. So Beyond Meat, you still could have been up 50, 60% as the general public. But why is it that all of these gains are happening just among the investor class that has access to those shares before they hit the IPO, before they hit the markets, but then once they do, the rest of the public is shrugging? I mean, these are hugely, richly valued companies, $30 billion, $100 billion respectively. Is that part of the issue here? And why is so much of that gain being privatized to just the big investors and maybe the retail investors with more access who are able to get in on that pre-market pop?
Well, I think there are a couple of issues here. One is the extremely high valuations at the market price. And secondly, why have underwriters been so bad at anticipating what that was going to be so that they didn't increase the offer price by more than they did? I think that indeed retail investors have a great deal of difficulty of getting shares at the offer price, so they wind up buying in the market. And institutions are also buying in the market as well. This year, we've seen a lot of money pour into various mutual funds and ETFs that focus on growth companies, and including a couple of funds that focus on IPOs exclusively. Renaissance Capital has their IPO ETF, and First Trust FPX ETF. Both have had huge inflows of money this year. They've had really high returns. And between them, they've had over $1 billion of new money to be investing in IPOs. So retail investors are both buying directly, through the Robinhood accounts or whatever, but they're also buying indirectly when they pour money into the hot mutual funds.
Right. Although I did ask Renaissance about whether they get IPO shares at the kind of list price or once they go public. They don't get pre-market access. They're actually buying them often 4 or 5 days after they hit the market. So the performance of that ETF is all the more impressive given that they're not able to get in on that pre-market pop. Tom, let me turn to you because you're right in the middle of this valuation issue on DoorDash. Why the downgrade today? And just tell us a little bit about what you think about how that IPO went last week.
Yeah, look, so, I think it's fair to say that the stock popped by more than we anticipated. I think stepping back, we've seen this often with other sort of brand name internet listings where, in the sort of the immediate aftermath of the listing, it's really more a function of supply and demand for shares, right? Here you had not a massive float, a well-known consumer brand that's had a lot of momentum. And sort of in the immediate term, we think the stock market really kind of reflects more that kind of supply-demand dynamic. People just wanted shares of this stock. In the long term or even the intermediate term, we think the market's efficient and it will basically value the company based on the intrinsic value of the company. But look, stepping back 3 days after the DoorDash IPO, we're still constructive on the business. In fact, we think, the immediate term, kind of the fourth quarter, first quarter numbers are probably going to be better than we're forecasting. But you look at the multiple on the next couple of years of revenue and presumably some EBITDA, and they're in some pretty rarefied air. So we just decided that, despite liking the fundamentals of the business, we thought it was the right time to step aside.
Shepard Smith here. Thanks for watching CNBC on YouTube.